evening, everyone, and welcome to Passive Investing 101. I'm really excited to share really how high income earners can start thinking about building generational wealth and through apartment real estate investing while also trying to think about how to decrease their tax burden. That's my goal today. And like I said, please feel free to ask any questions, toss it in the chat, and I'll definitely be able to get to them at the end. But tonight, really our goal in the next maybe 60 minutes or less is really to try to explore investment strategies. And when we think about that, right, it's not really through risky speculation, but I want to think about it from an angle of like just thorough, time-tested real estate fundamentals that we can combine with really sophisticated tax planning. And this isn't about getting rich quick, right? That's not what we're here to talk about, but it's how just high income earners, doctors, lawyers, pharmacists, executives, how you can think about systematically building wealth while keeping more of what you earn. And I want you to think that by the end of tonight, my goal is for you to actually understand how this works, think about real estate and think about adding it as the missing piece to your investment portfolio. That is my goal tonight. So before we dive in, I just want to take a moment to address something important, right? As accomplished professionals, whether you're listening to this online or you're here live tonight, I want you to understand the value of due diligence, right? We do a lot of due diligence in all our properties and what we do. So I want you to do the same, right? So this information that I'm sharing with you tonight, I want you to take it, digest it, ask questions, share the opportunities, and then review it with your trusted advisors, because I think that's the next step so that you are making a very important decision and a decision that you can feel very comfortable with. Okay, so let me pause and introduce myself. My name is Dr. Nkem Izamama, and I'm an emergency medicine physician, and I'm really glad to be here tonight. But I want to tell you why. You might be thinking, like, why is she talking to you today or to me today about passive investing? But I think my journey started maybe somewhere around 6 years ago. And I really, that's when I really started investing in real estate. And I didn't stumble upon it because I really loved medicine and all that medicine had to offer. But I was looking for alternative ways to grow wealth, right? My emergency department was bought over by a private equity firm, and things just started to change a little bit. And it was gradual, and then it was very glaring. It became a lot more about the business of medicine and less about kind of how we practiced and patient care. It first started with some hours being cut here and there, and then before you knew it, they were letting go of physicians. And although I didn't get cut, which I'm grateful for, it brought me to the realization, right? I finally came to that realization that even as a quote unquote physician, right, who is saving lives, my job really wasn't as secure as I thought it was. And so at that point, at that stage in my career, right, I started thinking, well, what is plan B? What is plan C? What is plan D? And I wanted freedom. And I know a lot of us talk about that, but what does that really mean? I knew that I could not rely on that one source of income, especially if it wasn't even secure, and that it could be just stripped from under my feet. That was really the impetus to make me really understand that I didn't want to trade all my time for money, especially when it wasn't even guaranteed. And so as a young physician, I was very diversified. I invested in stocks. I maxed out my 401k. I dabbled a little bit in oil and gas. I just thought about really other alternative assets. But the more I did research, right, the more I realized that the wealthiest of the wealthiest, right, they had their wealth steeped in real estate. And I wanted to be part of that. I wanted to understand, and I wanted to figure out really how my hard-earned income could grow for me. And so I started doing due diligence and research. And that's when I really started investing in real estate. But I quickly noticed that there weren't a lot of us in the space, right? We have the resources, but we don't have access. And so my deep heart was that I would start educating, healthcare professionals, busy professionals about real estate investing. And that's really how Phoenix Capital was born. And so I'm grateful to be here tonight to be sharing this journey with you as you start thinking about investing. So thank you for joining me today. And for those of you who are just joining, welcome. But I'm going to tell you some harsh truth today, and just stick with me. I want you to understand I'm giving you the foundation of why this is important. A lot of the benefits that we don't talk about, I want to talk about it tonight. So that first harsh reality that I want to talk about is that a lot of high income earners today, right? Taxes are a big part of our livelihood, right? And so a recent Wall Street Journal article just came out last month, and it said that the effective tax rates for high earners in some instances are now exceeding 50% in a lot of states. And that's when you combine federal, state, and local taxes. Just think about that for a second, right? You're working harder than ever, but you're keeping less than half of what you earn. That is like, if it's not mind boggling, then I don't know what else could be, right? So you think about that tax burden, right? And then think about just like market volatility, right? I remember in 2022, right, the S&P 500 was down, it was almost negative 18% in performance. And that reminded us, yes, it has bounced back, and we understand the ebbs and flows, but that just should remind you about how unpredictable and how volatile the market is, right? And so when you think about real estate, which is why I kind of pivoted to, shift my investment strategy to real estate, is that when I think about real estate, right, it moves very independently of the stock market cycles. And that simply means that it's uncorrelated. So when you think about that, right, as you think about diversification and how it works, right? And the kicker is that as a busy professional, like you're working 60 plus hours, you don't have time to like actively manage all these investments. So really need to look or be thinking about, what does true passive solutions look like while you focus on your career, while you build that foundation, because you need that foundation and that money, to work for you while you're continuing to work and build your skills and your expertise. So these three challenges, right? And this is what I'm going to break down for the rest of the presentation, but it's this crushing tax burden that we're facing, the market volatility that we see, and then the time constraints, because we all only have 24 hours in a day. That's why a lot of sophisticated investors are turning towards apartment real estate investing, because to some degree, right, it addresses all three of them, all the three things that I just talked about. But I want to ask you, as you're thinking, as you're sitting here, right? Why apartment real estate investing? Why multifamily? And the three compelling reasons I think that I can give you is, the first one is that it's recession resilient. And like, what does that mean, right? Housing is a basic fundamental human need. People always need a place to live, right? During the 2008 recession, multifamily apartment real estate was the first sector to recover, because even when people lost their homes, right, they still needed apartments, they still needed a place to live, they still needed shelter. So that's one important thing. And then the second one, it's that it's a natural inflation hedge. And that just means that if you look, right, as costs are rising naturally, right, with inflation, rents are also increasing. So like if your grocery bill goes up by 5%, although it feels more like 15% these days, right? But if your grocery bill goes up, so does your rent. And so that automatically protects your purchasing power over time, right? Because it is truly hedging against inflation. So the third thing you have to think about is all the tax advantages that come with real estate investing. This is what gets me excited. And if you have paid attention to the news lately, there's been a lot of talk about bonus depreciation. And so this is an asset class, right, that through depreciation, a lot of the cash flow, almost all of the cash flow that you're getting is going to be tax-free. So these are some of the things that you think about as you should be thinking about as you think about multifamily real estate investing. What should I invest in? How should I grow, in terms of generational wealth? These are the things that you should be thinking about. Okay, so I told you I'd talk about real estate a little bit, but I want to dive into the real power of real estate, which is depreciation. And this is where things, I think, gets a little exciting if you're a high income earner, right? There was an article from CPA Journal just last month, and it said that cost segregation studies, they can accelerate almost 20 to 40% of building depreciation. So that means that you're front loading all your tax benefits. And I'll explain that in a second. But I want to use real numbers to really break that down. So let's just say, sample $2 million property. In that $2 million property, you generate $94,000 in annual depreciation deductions. So what that means is that you get a structural engineer who will go in and do a cost segregation analysis, and they'll be able to depreciate everything except the land and the physical structure. But so for someone in the 37% tax bracket, right, that looks like about $34,000 in tax savings. But this is the beautiful irony about this, is that like the IRS is allowing you to write off all this depreciation, right? Because the property is losing its value, but the real estate is actually appreciating over time. So while you're claiming depreciation, right, it's appreciating over time. So that's why getting these tax deductions is just, it's very important in how you're thinking about your wealth strategy. Now, this isn't a loophole. It is truly an intentional tax policy that really encourages real estate investing. The government really wants people to provide housing, so they incentivize you with this tax code. That's what we're doing. And so being a part of this, you get all the benefits of this as well. But I want to share with you, so I talked a little bit about depreciation, right? But there are two really big game-changing strategies that every sophisticated investor should really understand. And the first one is bonus depreciation. We talked about depreciation, but now instead of getting those losses over 27 and a half years or 27.4 years, right, you can get all your bonus depreciation in year one. And so that's 100% of it in year one. And then if you don't use it, right, you can roll it over into subsequent years. So again, what can you depreciate? You can depreciate appliances, fixtures, flooring, landscaping, and your appliances could be anything from like HVAC, heater, think roofs, all of those things could be depreciated. And the only thing that you cannot depreciate is land and the physical structure. So imagine like writing off $200,000 in improvements in year one instead of spreading that over 27 years. That's what that looks like. And then I'll touch on 1031 exchange a little bit. So at the end, when we sell, right, any of your gains, you're going to pay capital gains taxes on it. But you can defer capital gains tax through something called a 1031 exchange. And all you have to do is you just need to continue to roll over the proceeds into larger or like property. So you can literally build a real estate empire without ever paying taxes or ever paying capital gains taxes, right? If you structure it well. And of course, like this is in conjunction with your accountant and with a specialist to help you. But when you start thinking about how you can combine depreciation, with maybe cost seg, a lot of sophisticated investors can really effectively reduce their tax rate by anywhere from like 10 to 25%. So this is not just like a few $100s, right? This really could mean tens of thousands of dollars in annual savings. And so these are the strategies that we need to think about as you start learning about investing, as you start jumping into investing. Okay, so now we talked about that, right? And this is the huge news. It has been on the news lately, but maybe some investors missed, and maybe you're one of them who missed it. And I want to bring that up because July 4th of this year, so a few months ago, right? You may have been focused on barbecue and fireworks because it was Independence Day, but the bill was signed into the Big Beautiful Bill. It's actually called One Big Beautiful Bill. It was signed by President Trump. And it was kind of buried in the news, but it is absolutely massive for real estate investors. Like this legislation actually extends 100% bonus depreciation for real estate investments. That means you can get all of that depreciation year one. And that's really important. You don't have to spread it out over 27 years. Now you can get it year one. And every single property that was acquired after January 2025 can qualify for this. What you don't know is that this was supposed to phase out. So like 2023 started dropping by 20%. And within the next 2 to 3 years, it was supposed to phase out. And now it's locked in at 100%. So it's really for qualifying properties, right? You really can deduct the full cost of depreciation year one. So the government is just essentially saying, we want you to invest in real estate. We're going to make it incredibly tax advantage for you to do that. And this is what it looks like. Okay, so this is something I want to talk about this, and I really want to focus on taxes because it's important as you start thinking about investing, right? You want to keep as much of it as you can. So there's something called, and I'll talk about this real quickly, but if you want more information about this, please reach out to me and I can talk to you and kind of educate you and then point you to, an accountant who can help you. But I want to talk about real estate professional status. Now, this is really more of an advanced strategy, but it can be really powerful for people who want to take advantage of it. So, and again, right, I as much of as an expert as I am in learning and understanding and conveying this information to you, I want you to take it back and I want you to talk with your accountant, your tax strategy, and see if this is something that you can implement. But the IRS has very specific requirements, right? In order to be a real estate professional, in order to qualify to be a real estate professional, you need 750 hours annually in real estate related activities. And it has to be more than 50% of your total working time. So I know what you're thinking, right? If you're a lawyer or a surgeon or an executive, right? And you're like, I can't spend 750 hours on real estate. You are right. So maybe you might not qualify. But here's the thing, right? Maybe your spouse might qualify for this. And what you have to understand that like as your real estate portfolio grows, right? You might want to transition to focus more on real estate. But what are the benefits of being a real estate professional? The benefits are enormous. So I was talking to you about depreciation. Well, with depreciation, right, as a normal investor and you don't qualify for real estate professional tax, that will offset your passive income. But as a real estate professional, right, you can offset your W-2 income with your real estate losses without any passive activity limitations. So you don't have to it's not only for all your passive income, it can also offset your active income. So your W-2, your 1099, but you have to qualify. So, and like I said, like your accountant can help you figure this out, but you just need to know that it is available to you. And that's why we're having these conversations. That's why we're having these webinars, because it's really important. And even if you don't qualify now, right, I want you to realize that it's worth understanding because your investment strategy is going to evolve, right? Real estate is going to potentially become a larger part of your investment strategy and the plans that you want. So I want you to know and understand these opportunities as they're available to you. Okay, so I want to walk you through real numbers so you can really see how these tax benefits really work. So let's just say you invested $100,000 in one of our deals, right? Let's look at it from just an annual standpoint, so yearly. So in a year, you're going to receive $6,000 to $7,000 in annual cash distribution. And that looks like 6 to 7% cash on cash, right? But this is where it gets interesting. So if I give you that let's just call it 7,000, right? So your share of your depreciation, we did cost segregation and we got depreciation. And let's just say for your $100,000, right, you are going to be getting about $8,500 annually in depreciation. Now, this depreciation is a paper loss. So it's going to offset all of that $7,000 that I gave you in your distributions, like all of that. So that means that for that $7,000, you are paying zero in taxes. You're not paying anything. That's money that you're keeping. It's just completely tax-free. But now you have, because I told you like depreciation was $8,500, let's just say we're looking at it annually, right? And you have $1,500 remaining, right? That can offset any of your additional passive income that comes in. So if you're in the 37% tax bracket, right, that's going to save you like an additional, maybe somewhere around $3,000 in taxes. So if you add up the $7,000 that we gave you in your distributions, plus around that $3,000 in other income that you're still able to offset, like your total economic benefit on investing is about $10,000 on your $100,000. So that's the way to start thinking. That's, people don't understand, investors don't understand it. And this is something that they don't discover. So talking about this is very, very important. So we're talking about passive investing in real estate, right? So how do we invest? And it's called syndications. And I want to just talk to you about syndications very briefly. Syndications are a way to make real estate very, very passive for busy professionals. So I want you to think of it like this, like, right, you are essentially buying shares into a specific property, but instead of getting a stock certificate, right, you own a piece of that real estate, like it is yours. And so as a limited partner, right, your only job is to provide the capital, and then you receive ownership in a percentage form. You have zero management, you have no tenant calls in the middle of the night, no toilet is clogged, you don't have any maintenance headaches, you're just pulling money together. We are all pulling money together, and then you are truly passive, but you're benefiting because you are part owner of real property. Then on the other side is the general partners. So the syndication is made up of limited partners and general partners. And the general partners, which is us, we handle everything. So think through finding the deals, analyzing, managing the operations, all the making the strategic decisions, thinking through the exit strategy. And I'll walk you through what that looks like, right? And then we also hire third-party property management companies that they handle the day-to-day. So the tenant calls and the maintenance, all of that, they take care of that, right? So we take care of all the hassles. That's what passive investing really looks like, because then you get to focus on what you do the best, what you love the best, while you're building capital in order to be investing and getting passive income. Okay, so this is a sample timeline of what to expect as you start thinking about investing. So first, we source the deals, and I'll give you like a pyramid scheme in a second of what this looks like, but kind of brief overview. We source a deal and we'll analyze it. So this really takes months of market research, a lot of relationship building. But when we find a good deal, we go into a due diligence period. And that's a period where we inspect everything. So look through the financials, physical condition of the property, market analysis, everything. We go deep into it, right? And when we do physical due diligence on the property, we take the entire team, property managers, roofers, plumbing, landscaping, construction, everything. We go to the site and we look at it. We look at we walk into every single unit. We look and see what our business plan is and how it's going to come to life. But all of that, is part of what we do. And then after that, we go and we raise capital. The raising capital phase takes about 60 to 90 days. And then we hold these properties after purchase, right? After acquisition, we start managing it and we hold it for about maybe 3 to 7 years. Our sweet spot is around 5 years, but it could go a little bit longer. And in that period, right, we're executing the business plan. So we're thinking through, what are we going to renovate? How many units are we going to renovate? Are we going to do, what exterior plans are we going to do? We're thinking through all of that. We're also thinking through the rent increase, right? Where's the market? And where's our property in relation to the market? What do we need to do to get to market? And then when we do renovations, how much are we increasing it to? So all of those operational rent increases and operational improvements, those are the things that we're doing. And then at the end, we'll exit it. And our exit strategy is either we sell it to another buyer or we'll refinance it. And then when we do that, we'll return some of your initial capital to the investors. So that's what this whole period looks like. And during this process, right, you could expect anywhere from 6 to 8% annual cash yield through distributions. That was that tax example I gave you of the 7,000 on the 100,000. So anywhere from 6 to 8%. And you're looking at maybe on your initial investment to when you sell, you're looking at making about 1.8 times, anywhere from 1.8 to 2 times your equity. And this is the best part, right? Around like 70% of the cash flow is all typically tax sheltered through depreciation. And that's what we're talking about. So really all of that, like 68% in distributions, it's almost all tax free. That's the benefit of investing in real estate. And these are some of the opportunities that maybe we don't know about that you're here today and you're listening. Okay, so I want to talk a little bit about market fundamentals, and I'll keep this very high level. But when we think about the properties that we're, the location and the properties that we're trying to buy, it's really important to think through like what economic drivers are in the area and how the location is doing. So one of the big things is like looking at markets that have very strong job growth and really population influx that are going in. So think about companies like Meta in the area that we're buying in. We're in Georgia right now, right? So Meta is coming in. Rivian EV plant is also coming in, and a lot of like high-paying tech jobs are coming into the area. What that means is that with these jobs coming in, people are coming in, and again, people need a place to live. So we are there to provide really quality housing. And these are not like fly by the night companies, right? These are like solid companies that are coming in and they're really creating housing demand. So we're grateful for that. But these are some of the things we think about when we think about where we want to invest in, the markets that we want to enter. And then we really it's very important that we partner with the right property managers. And we have found a wonderful property management team that we partner in the Southeast. And they are really focused on the tenants and really improving operational expenses. They're really working on improving, kind of thinking through rent growth, our renovation strategy. All of that is really making sure that we link arms with the right property management team. And they manage $1 billion in assets. So it's good to have the right team to help us really execute our business plan. Okay, so I told you I kind of wanted to just walk you through what this whole process is from A to Z, right? I don't want us to get caught in like shiny object syndrome or like bidding wars. So we really think through everything that we do very just like with a strict method to how we're doing it and a very professional process. So I told you in the beginning that we underwrite every single deal and we make very conservative assumptions. So really what that means is that these deals are stress tests with multiple scenarios. So what happens if there's another COVID, or what happens if, what happens if the market changes? What happens if interest rate does what it does? Like all of those are thinking through how we stress test the deals. And then after that, right, we have an external team. So think accountants, they review the deal, insurance, lending, property management team. I told you about our property management team. They all see the deals that we're looking at. They all give insight on our numbers, where we are, if this is the right price we want to buy it from. But all of that we take into effect before we make an offer. After we make the offer and it's submitted, that's when we go into formal due diligence, right? I told you all the inspections, like even environmental reports, market validation, financing confirmation. We're really partnering with the lenders on making sure that we have the right deal, the right type of financing, how we're going. And then the next thing we do is sign the purchase and sale agreement. And after that, right, then we start raising capital in order to get the funds needed to close. And then after that, we start implementing our business plan. That is the systematic approach that we take every single time so that we meet or exceed our projections. And those are the things that we're doing every step of the way. Okay, so I want to talk to you about our case study. And this is our current success story that we have, which is Grove Park View. I don't know, some of you on this call might be in this deal, but we acquired this 268 unit in March 2025. And we just delivered our first distribution to our investors. So we say 1 quarter after we close, you're going to start getting distributions. And for this deal, that was just 4 months after acquisition. And it's important, right? It's good to see that. It's good to know that, because it shows that we're not making you wait for years for you to see returns, right? You're seeing returns shortly after we close because the deal's already cash flowing. And so we want you to benefit from that. That 68%, that's where this is coming from. And again, right now, the property is at 93% occupancy. We want to get it to 95. It's not there yet, but we're doing all the things. We have all the things in place. We have, kind of all the metrics that our property management team needs to meet in order to get it there. So we're getting there. But I want you to kind of share in these numbers, right? Because it tells you, one, the quality of the asset and the strength of the market, because it is doing well. And we've already actively started implementing our business plan. So some of the things that we're doing is we are doing a lot of landscaping just to enhance curb appeal. Because when you walk into a really beautiful building, you're like, I think I want to be, I want to live here. But we're also updating the roofs. We are definitely adding a dog park because it's just pet-friendly amenities. They really command higher pet rent, higher rental income. And so we want to make sure, and a lot of our apartments are, a lot of our tenants are dog friendly. So why not give them the right space and the right opportunity for them to bring their pets in? And then we have a car wash station. It was already on site, but we're making it better. We're improving it. So that's some of the things that we're doing when you think about kind of starting to implement our value add strategies to our business plan. But one of the other things that we're going to do, which we are starting to do, is we're going to convert, we're just doing one test first, but we're one pilot. So we're going to convert one of the studios into a 1-bedroom. And the goal of that is to see, because the studios are really large. And so we are able to do that. If we're able to do that, right, and see if we can capture rents, then our goal is to kind of improve that. The next time we do a bunch of turns, right, we're going to start upgrading. So we'll do one, we'll see how the market takes it, if it's something that they like, and then we'll go. But I want to share this with you because this property, it really demonstrates our ability to execute quickly and to start delivering returns for our investors. But our goal at the end of the day is thinking long-term. Okay, so another property is the Rise, right? And the Rise is another property in Georgia, but it's a different, I'm bringing it to you so that you can see a different investment strategy. The Grove Parkview was an older property, and we're doing a lot more renovations, but the Rise is a newer property. It's 2022. It's a Class A property. It's 128 units, so it's more than half less than Grove Parkview, but it's newer with really premium amenities. So the focus here is really going in and maybe doing more smart package implementation. So like enhancing the living, just enhancing like living environment, and then also manage it better. So really optimize operations, how it's doing. So that's our goal. So we're not going in and renovating a bunch of units because it's brand new. So there's a lot less capital investment that is coming into the deal than, let's say, Grove, that had a higher capital investment because we needed to put more money into capital expenditure and renovations. But so this is more, the reason maybe why you would do this versus the other one is maybe this offers a little bit more stable, immediate cash flow because it's a newer property, and there's not a lot of turning that we need to do. So I would say if this is more for like a conservative investor who wants current income now and then thinking about maybe a lower execution risk. So we are as well just as excited to have this in our portfolio, because then for someone who's like a new investor, as you're thinking about passive investing, right, we're able to underwrite older properties with a more higher renovation, a larger value add plan, and then also look at this, right, with a kind of a newer property that's a little bit more stable, more cash flowing. So, and this is another thing, right? Even inside of real estate, right? It is just as important to diversify. So you're not only diversifying across asset classes, but also inside of the same asset over different years. So that's just something to think about. Okay, so this is another thing that I just want to talk to you about is the oversight on all our investments. And this is very important. These are questions that you should be asking, the team that you're working with, the sponsors, like what does due diligence look like? What does the property management team look like? What does protection look like? So those are things that we take very seriously, and they're almost non-negotiable. And so from a legal standpoint, just again, high level, I want you to know this, right? We always have, every deal really includes a private placement memorandum, and that's really just our subscription agreement between you and I. And it will detail all the risk, all the projections. So it's important for you when you get that document to really review it, read it, understand it, because I always tell my investors, right, this is your hard-earned money. You want to know what's being done with it, how it's been done, kind of all the risk, what the projections are, what forward-facing looks like. I want you to think through all of that. You have access to it. So it's a document that you will sign, I will sign, and it was drafted by our legal team. But then you have the operating agreement, and that really just clearly defines everyone's roles, responsibilities, profit distribution, so that you see, right? Remember I told you that you're buying shares into a business and you're part of it, right? You own part of it. So it's good to know what profit distributions look like, where you lie, and how the deal works. And then you will also receive your annual K1. So that's the K1 that will have your depreciation on it. It's prepared by our professional CPA, our accountants. And then even on top of all of that, we also have regular communications, and you'll hear from us every month. My investors tell me every month they receive our newsletter and our update. They're like, thank you for providing that. And then we also have quarterly investor calls. So this is a time for you to come ask any question. No question is off the table. So ask anything, because again, you're part owner of this, right? So as you come in, this is something that's really important. Again, I tell my investors, like, if you are looking to invest maybe elsewhere, right, make sure that you're working with people who are very transparent, who are communicative. No matter how the property is doing, like, you should know, because again, you're part owner. So this isn't a quick, handshake deal. You meet us in Atlanta or like any of our other, where our other properties are. It's not just a quick handshake, you walk away. There's tons of documentation, tons of processes, because we want to protect your investment. And so it's important to us. It should be important to you as well. Okay, so timing is everything in real estate. And as you're new to investing, right, as you're thinking about it, you really need to understand where the current market is, what current market conditions are, and how those really create unique opportunities. So we are in a season right now, right, that is like a lot of motivated sellers are wanting to sell just without being, so think about, like, there was a frenzy in 2021, 2022, where there was like peak buying frenzy, where everyone, like, it was truly a seller's market, because they could command any amount and people would buy. And it's a little different now, right? Because interest rates were really high, and so not everyone was motivated to buy. So it's a kind of a peak pricing environment where, like I said, you have these motivated sellers that are really accepting more reasonable valuations. So like, we are underwriting and it's making sense. And then you also have some institutional buyers that have pulled back because they're just not comfortable with where interest rates are. So it's reducing competition. So for the savvy investor, right, this is a good time to go in and buy, as long as like it meets the metrics, it meets the numbers, and the deal makes sense, right? So you also have to know that as you think about, these are some of the questions you need to be asking when you're talking to sponsors, when you're talking to general partners, when you're talking to the operators who are leading these deals. And also remember, right, this is long term. So you want to take advantage of what the current market is doing, and knowing that, like, we're holding for long term. So we're holding for 5 years. Okay, so this chart is busy, but it's really important. And I just want you to, if you want to, you could take a screenshot of this chart, because it's really important. And I really just wanted to compare apartment real estate investing with other investment options that you have, right? So I use five criteria to compare. And the first one is income generation. So multifamily apartment real estate, you're getting somewhere around 68% in cash yields versus maybe 2 to 3% that you get on bonds. And then minimal, you're barely getting any dividends on your growth stocks. So that's something to look at. And then when you think about tax benefits, I spent a chunk of the beginning talking about tax benefits, because the tax benefits here are unmatched, right? There's no other asset class that will offer depreciation deductions that will help you shelter your cash flow and offset some of that income. So that's also really important. And then I also talked a little bit about inflation, right? So you are getting, real estate is an excellent inflation protection, because rents adjust with inflation, while sometimes bonds will get crushed because they have zero control. So that's another thing that you have to think about. And I put this across, across the different classes for you to be able to compare it. So, and then when you think about for control level, right, you have moderate to low control over the outcomes through asset management decisions, unlike stocks that you have zero control. So here, as a limited partner, like, you understand what's going on and you're made aware of it, but you do have limited control. And then liquidity is probably one of the biggest downsides, but it's something that you have to compare, right? Because you just need to have all your facts. But liquidity is significantly lower in real estate. But the truth is, the reason why it's low is because real estate investing is really more of a long-term strategy. It's a long-term wealth building. And what it does is, like, it avoids emotional decision making. So you're not changing your mind today or changing your mind tomorrow, right? You do your research, you commit, and you think about it more long-term. So I would say that the unique advantage to multifamily real estate investing is that it's one of the only asset classes that will combine the depreciation benefits we talked about, and then having direct ownership of really a tangible asset. I think that's really important. So you're not just buying paper, right? You're not just buying a sheet of paper, you're actually buying buildings that people need in markets that have sustained demand. So when you think about like, how can I compare? What do I want to do? I will say this, right? You should be diversified. So you shouldn't put everything into real estate. So you should think about stocks and bonds and, maxing out your 401k and thinking about additional alternative assets. But maybe looking at this comparison chart will help you think through what the decision could look like. Okay, so we're coming to kind of an end, and maybe like the next maybe 10 minutes, but I just wanted to kind of share what we've done and why you want to partner with us, or thinking kind of long-term, thinking in the future. And the three reasons I can think of are, number one is proven track record. So you can see kind of what we've done, what we've acquired, who our partners are, where our growth plan is, our growth strategy is. So that's definitely that's there and it's very visible. And if you schedule a call with me, I'll definitely walk you through it. But there's also market expertise, right? Going into the market, building relationships with brokers, with property management, with accountants, with insurance companies. All of that is important. And then I think the most important thing is like an aligned interest, right? So we are successfully managing millions in assets, and 100% of those deals are meeting our projections, right? Where we're heading. And that number continues to change on a daily basis, but like we are pushing to it and our goal is to exceed it. I think one of the most important things that I'm grateful for is that we haven't lost any investor capital. And I think it's never happened, and it's not luck, right? It is true systematic underwriting. It's really conservative assumptions. And we really go into the market. We're constantly reviewing what the market is doing. We're reading CoStar reports. We're using that to make assumptions and really understanding what the market is saying. And I told you, right, like one of the biggest things in market expertise is really building relationships. So the lenders, the brokers, the property managers, because we don't do this alone, right? We really are a team, and we're a group as we bring these assets to our investors to help them grow wealth. But I think the thing that matters the most to me, and that's what makes me excited, is that like our interests, my interests, are completely aligned with yours. And so we invest significant capital into every deal that we sponsor. And our success fees really are tied to investor return. So it's not just like managing the asset, right? When you win, we win. And so that's what we have to think about. And the way I think about it is that we're building long-term wealth alongside our investors. So this is not just like I'm collecting fees today. And like I said, right, when you win, we win. And when you don't, we don't. And that's very important. So I think, of all the things, when I think about partnering with us, I think that aligned interest is the most important. And when you talk to other sponsors, other partners, other operators, these are some of the questions you should ask them, right? Who do they have relationships with? What are their interests? How is it aligned? How do they get paid? All of those are important things that you should ask, especially as you're new, especially as you're thinking about investing. Okay, so this really excites me because alongside our investors and our partners, we've been able to invest and acquire in assets totaling about $120 million. And I think that is just really humbling and gratifying because I've been able to help investors, start generating passive income, start thinking about their future. And like we have done it together. And so if you're listening here, right, to every investor who has believed in what we are doing, where we are heading, our vision and our mission, I just want to say thank you from the bottom of my heart, because we couldn't have done this without you. And we're just starting, right? We're just growing, and we're just getting into the market, and they're knowing who we are, and we're winning. But we're winning because you are winning. And so I want to talk about kind of where we are right now, right? We do have some spots still available in those 2 deals that we're currently managing. Grove Park, we have just a very few spots that are remaining, but they're still available. But it's a different approach because we're already managing the property, and like I told you, it's already performing, it's paying distributions, it's doing well. And so you can come in where we are today. You're not going to get all the things in the past, but you will get, you'll get returns and cash flow moving forward. And then the Rise is really more of a pre-closing investment window that we created. But it's also to think about kind of our next investment, our next acquisition. So right now we have in the pipelines opportunities that we're currently underwriting in the markets that we really like, that are thriving. So we have stuff in Q4 that we're looking at for investors who kind of want to think about maybe committing some capital to future deals now and then moving forward. Our minimum investment is $50,000 and it's for accredited investors only. I think I've told you before, but you'll receive quarterly cash flow distributions 1 quarter after we close. And then you get your annual K-1 document, and that's prepared by our professional CPAs. You get regular updates, quarterly calls. And so the calls, we just get on a Zoom call and we just talk. I run you through our, the financials, where we are up to the point that I'm speaking to you at, and kind of where we are with renovations, what our plan is moving forward. We just kind of talk through the property. And then if you have any questions, we welcome it. But that's kind of what this looks like, right? And so, and then again, as you get in, right, you have access to our investor portal, and that's where you can track everything 24/7. It's yours. We don't have access to it, but you'll see how the property is doing. You'll see what your returns are. You'll see all the funds that you've received. Everything is available on the portal, and you have 100% access to it. But I would say this, right? This isn't, and this is kind of, I told you I was coming to a close, but the plan that I'm kind of sharing with you, right? It's not just one deal. Think about this as building long-term relationships, with your operators, as investor and operator who can systematically really build wealth through real estate. That is the goal when I think about where we're heading together, right? It's not just a one deal, but it's figuring out how this aligns with your future goals, your wealth building strategy, what you want to do, next steps. Okay, so you're wondering, where am I? What are we going? And I wanted to make sure that I left time for some questions. I think I see some questions coming in, but so this is the path forward, right? If you're ready and you're thinking about transforming your investment strategy, or, start thinking about building tax advantage wealth through real estate investing, right? The first thing I want you to do, and our team is going to put up a link, is just schedule a call with us. My heart is that we can discuss like your specific financial situation, your investment goals, and then see how, if it works, and how we can make it work, right? This call is more of like strategic planning. It's a strategic planning session, and it's to see if like real estate investing makes sense for your situation right now. And then from there, right, we'll then provide detailed kind of summaries of the current opportunities so that you can review it, think about it, or even just be in the pipeline for the future one. That's what the conversation's about. Oh, another thing we have to do is we have to do an accreditation verification. So just make sure that you qualify, because that's required by the law for private placements. So we just need to make sure that you're accredited. We take care of it, but that's something that we'll do on that call as well. And so if everything aligns, right, you'll get into the portal, you'll fill out all your information, you sign the subscription document, and then you'll fund your investment, and then you'll start receiving quarterly distributions while you're thinking about building long-term wealth, and you're not thinking anymore, you're doing. So that's kind of what the whole process looks like as you start thinking, is this the right time to start? But I would say, if you're unsure, if you're questioning, just jump on a call with us. Someone from our team will reach out to you. We'll set up a call, we'll have a conversation, and then we'll go from there. I'll leave you with this, and then I'll jump into questions. But the best time to plant a tree was 20 years ago, right? And the second best time is today. So if you didn't do it 20 years ago, think about doing it now. Think about starting now. And so, yes, I just want to say thank you. Thank you for your time. Thank you for the opportunity to just come together tonight and listen and then ask some questions. But I really look forward to helping you build wealth through multifamily apartment real estate. Again, thank you. And yep, I'll jump into questions. Let's see. Okay, I see there are a bunch of questions. Do you want to pull it up? Perfect. What is the biggest mistakes that new investors tend to make, and how can we avoid it? I would say that you need to do due diligence. I think the biggest mistake is maybe jumping in with the wrong team, the wrong operator. So I would say in the beginning, ask questions. There's no question, like you shouldn't ask me a question that I cannot answer or I'm not willing to answer. I've had investors even do background checks on us. So it's important, right? So I would say ask questions, know what it's okay. Don't be afraid if you don't know it toss it out there, but the hard questions, you want to answer the hard questions up front so that you don't make mistakes on the back end. What tools or platforms do you recommend for new investors to research and manage their portfolios? So I would say in terms of tools, I would say reading is the first thing, right? In terms of learning, I think education is the biggest thing that you can do in the beginning. And it's really reading. Sorry, 1 second, I'm drinking some water. So I would say in the beginning, it's reading, because education is the most important thing. You have the resources in terms of capital, but you want to make sure that you're deploying your capital correctly. And I think the first thing you do is reading. And the second thing I would say is podcasts. So they're really solid podcasts that just have free educational information to give you, that you have access to, that will guide you in kind of what to do. I think in the beginning, right, learning what you want to invest in, the type of investments, where you want to invest, I think you have to do that first. And then in terms of managing your portfolio, right, whatever group that you invest with, they will have their portfolio that you have access to. So you don't have to manage your own. You can do it alongside the investment group that you're investing with. What's a practical first step someone should take after attending this webinar to get started with investing? Oh, this is a great one. I mean this, right? The best thing you can do is just schedule a call with me or someone on our team. And the reason, I think the reason why this is important is because you don't know what you don't know. And so it's sitting down and maybe having us ask you the questions, and us helping you think through next steps, what you need to do. And it could even be like, hey, go read this or go listen to this, start with this, and maybe this isn't the right time, come back. Or, then we kind of give you a portfolio of kind of all the deals and say, this is why this is good. This is why this maybe fits a little bit better with your investment strategy, your kind of your thought process, your mindset. So I would say the next first step is like schedule a call. And then after that, right, I would say start joining groups. Another thing I think is important is like there's tons of groups that can help you, or like-minded people who are thinking about investing, who want to invest with you, or who just want to share information. So putting yourself in that right sphere, I think, is really important. Regarding the future deals, are some separate from Excite? The current investment opportunity and collaboration with Excite. Once you get to the raising phase, do you send a bulk email to the list to alert them? Great question. So this is a wonderful question. We partner with Excite, not on all deals, but on the current deals we have. And they are a wonderful group that we're partnering with. I'm thoroughly excited to be partnering with Dr. Oni, Leslie Awasam, Kenny Tolafari, and our partnership structure at large. So yes, the deals we currently have are with them, but yes, you are right. Once we start raising capital, as soon as we sign the purchase and sale agreement between the buyer and the seller, we send it out to our groups, and we send it out to our community, our email list, and we want to alert people on at that point that we have signed it. The deal is, we're in the process of buying it. We're on the path to closing, and that's when we start getting capital, and that's when we start raising capital, and that's when we start focusing on closing. And there's a lot of stuff that goes in on the back end that you don't see. So that's when we start securing lending. That's when we also get the property management team to start getting everything in order. We're still currently looking at financials, because that's about a 3-month process. So we're currently reviewing financials, even though we don't own the property yet, right? That even though the sellers are still, they still own it, we still have access to the financials to see how the property is doing. So all of that is happening on the back end. You're welcome. You also use Cashflow Portal? Yes, I also use Cashflow Portal. That is correct. How many investors, how can new investors stay consistent, avoid emotional investing during market downturns? So this is where I think you're thinking long-term. So these downturns will happen, right? But with real estate, right, it's very cyclical. So it will go down and it will come back up. So we're investing long-term, right? So that's where time kind of helps you, because it just with natural cycle, right? You might invest at a time where things are not as great, but you're going to just stay for the long term. So I think that's important. And then staying consistent, right? One thing that we're doing at Phoenix, right, is that we are still buying. So even though, interest rates are still a little bit higher, right, for the right opportunity, we will buy. So our current investment opportunity, we bought at a 5% interest rate, 5.13 to be exact. So although that's a little high, it's still it still works with our investment and our business plan. So I would say kind of one of the things to do as you're thinking is making sure that the operators are still buying with like in the right deals. And I would say that to avoid emotional investing is just kind of staying on track, really reading, really understanding what the market is doing. So like I talked about joining all these groups, right? You get access to what's going on. You're reading constantly, following up on what the market is saying, what the news is saying. So where we are, what the plans are, what's happening with interest rates. But I think it's just staying informed and staying educated are the two things I would say are the most important. Someone in LinkedIn asked you to talk more about 50K minimum. Okay, let me talk about the $50,000 minimum. So this minimum is for, number one, is for accredited investors, right? So the minimum investment is 50,000. You don't have to invest only 50,000. You can invest as much as you want, up to a certain amount. But our truly minimum is 50,000. And this is a number, I think. So one of the conversations that I'm going to have with you, right, when we have our strategic call is really figuring out if you qualify. So this 50,000 really should be disposable income. So it should be additional income that is not your security, that is not like your security deposit, that is not, your emergency fund. It should be additional capital that you really want to start growing wealth with, that you really want to think about passive investing. So I think that's very important. I do think that the minimum is something that needs to be there. And I think it also, you might not qualify now, but maybe in a few years, you might qualify. And I will say this, right? This, even though we have a $50,000 minimum, there are some deals that we will do in the future that we open up to non-accredited investors. But those deals kind of don't come along very often. So it's something that we only, we keep it for our community, because one of the requirements is that you and I have to have a prior relationship in order for me to even tell you about those deals. So I think another important thing, I digress a little bit, but it's like staying in communication with us, making sure that you've scheduled a call so we can have the conversation, so that when those deals come, right, it's an opportunity that I can now share with our community. I hope that answered the question. Based on the two offerings, what type of distributions can investors, there's one more question. Based on the two offerings, what type of distributions can investors expect? So both of them are, but you're going to be getting about 6%, and that is preferred return. That's yearly. That's your annual returns. And then for Grove Park View, it's coming out. It's about 15.75, and then and that's percent average annual return. So over the life of the deal, you would be getting about $15,000 yearly when you look at it. So on a sample $100,000 investment for Grove Park, you would be getting about $178,000, and then that same deal for the Rise, it's about 16.14. So that looks like about 184,000, and throughout the investment, and that includes return of your capital. That was a question I think that just popped in. Okay, this was really good, and I really appreciate all the questions. If there are no other questions, we will wrap up. I'll keep it for a second longer just to see if any questions pop up. Okay, well, I just want to say thank you so much. Thank you so much for spending the hour with me, and thank you for those questions. I would say if you have any further questions, right, feel free to schedule a call. And I think our team, it was up, but I think we'll quickly put it in the chat. But click on the link, schedule a call, and then we can really go through in detail your investment strategy, your goals, where you want to go, and how we can help you achieving that. So I want to say thank you on behalf of the entire Phoenix Capital team. Thank you so much for coming out tonight. Have a wonderful evening.